Partnerships can look and feel like limited liability companies, but partnerships have different aspects to them. A basic partnership will involve two or more people who have shared ownership in an entity. And we have two basic types of partners. You have general partners and limited partners. General partners, they will be the partners typically running the business, making decisions, responsible for the business results, and ultimately hold the most liability of the partnership. On the other hand, you can have limited partners. Limited partners will have limited liability to the partnership. Limited partners will play a more passive role in a business, and they're more likely going to be an investor in that partnership. Now, several types of partnership structures include a general partnership, what we've kind of talked about so far. This is where, at minimum, two or more people have ownership in the partnership, and those partners are personally liable to the debts and obligation of the partnership. A limited partnership, an LP, will have a general partner with unlimited liability and limited partners with limited liability. The general partners will typically be the ones running the business. The limited partners are going to be the ones investing money, cash, capital, whatever into the business. Limited liability partnerships, an LLP, gives each partner limited personal liability, which protects the partner against partnership debts and actions taken by other partners. You'll see LLPs with a lot of professional services companies. These are where partnerships are coming together, combining their skill sets, whether it's attorneys, whether it's CPAs, and each partner wants limited liability to the overall partnership and actions taken by other partners in that partnership. All right, let's go over some taxation considerations when you're setting up a partnership. Like an LLC, all partnerships file tax form 1065, and all partners, owners of the partnership, will receive a K-1, which they will report on their 1040, and that's where the taxes gets paid. This is a pass-through entity. In our quick example of K-1 income from a partnership, an LLP in this scenario, we have $1 million of net income from the LLP, and member Paris and partner Paris owns 25% of the partnership. Paris will receive a K-1 for $1 million times 25% of his ownership, ultimately getting $250,000 of K-1 income, which Paris will report on his 1040. I also want to mention this concept of basis at this point in time. Basis will apply to pass-through entities. Therefore, owners of a pass-through entity like an LLC, an S-Corp, or partnership will want to understand what basis is. And at its simplest form, when you contribute money to a partnership, LLC, any sort of pass-through entity, that will increase your basis. If you can think about stock basis, that is your basis if you ever go to sell or get a distribution from this pass-through entity. What increases your basis within your ownership of your pass-through entity is net income, or if you contribute any more money. Those particular items, at its simplest form, will increase your cost basis, your basis in the pass-through entity. What will decrease your basis in a pass-through entity is distributions. You received money from the pass-through entity, or if there's net losses. Net losses will also reduce your basis, your ownership, your cost basis in a particular pass-through entity. Basis, I just want to point out, is important for distributions and selling any ownership in the future. So you want to have a good idea what your basis is to get an idea what your gain might be if you ever sell your pass-through entity ownership. All right, let's go through some pros and cons of partnerships. Pro number one, this is an easy way to combine skills in an entity. A partnership is an easy way for two or more people to join forces and benefit from each other's skills. For example, a tax accountant and an audited accountant can form a business to offer full service accounting services to businesses. They can help with the tax preparation, and they can also help with audit, review, compilation work as well to offer full services to their client base. Pro number two, flexibility. Partnerships offer flexibility in the same way that limited liability companies offer flexibility. You can have as many partners as you want, and you don't have to pay out distributions pro rata to ownership. This is a great option, and it'll make a lot more sense once we go into S corporations. Pro number 3, raising money. Raising money in a limited partnership is a lot easier than raising money in a limited liability company. The ability to have limited partners gives the opportunity to raise cash for the business. Limited partners have limited liability, and they are also not subject to payroll taxes. Con number 1, partners in themselves. Working with other individuals, human nature, can be challenging. Partnerships need a well thought out partnership agreement. Partners therefore need to predict and think about where their business is going, how many partners might join the partnership, and what problems might arise in the future. Now, you're not going to hit everything in your partnership agreement, but if there's some key things, if there's areas that you could see that are going to be contested or be arguments in the future, I would identify those and put them in your partnership agreement from the get-go. The stronger, the more detailed a partnership agreement is, the better off you will be in the long run. Disagreements among partners is inevitable. Con number 2, payroll taxes. General partners are considered self-employed and are subject to payroll taxes, Social Security, and Medicare taxes. That can surprise owners of a new partnership that they are subject to self-employment taxes. Con number 3, selling partnership ownership. Trying to sell or exit a partnership can be a headache. You will have to navigate the partnership agreement. Once you have navigated the sale, you'll have to figure out the tax treatment for all the pieces that might be included in that sale, which might involve multiple tax categories, meaning you're going to need a good CPA when you're selling a partnership ownership.